After finally getting a bounce around this time last year, Ford shares now back in a downtrend today, extending that lower 9% after the report last night. We're going to talk Ford GM. We got Tom White in studio with us. Garrett Nelson is joining, equity analyst at CFRA Research. So Garrett, I know that you've got a buy on Ford, so give us the positive story on here, because right now the market is not liking what it sees.
Sure. So thanks for having me. It was an ugly release. They missed their 2020 EPS guidance. Was a disappointment. That guidance was below consensus. But we actually think the worst is behind Ford now, and we do find deep value in the name here. We think it's a deep value play at this point. They reiterated their commitment to the dividend, which is now yielding over 7%. The stock's trading close to a 52-week low. And we do see some evidence that they're in the early stages of a turnaround with some of the products that they're coming out with. You saw during the big game the other night, the ad for the Ford Mustang Mach-E electric vehicle. The comps for that vehicle are very similar to the Tesla Model Y, and they've already sold out of the first version of that vehicle. They also have the 2021 Bronco, which will be debuting in the spring. And they're also doing some interesting things in their collaboration with Rivian and some new electric vehicle models under the Lincoln brand. So, it was an ugly release, but we're viewing this as a buying opportunity.
Now you've got a $10 price target on the stock. One of the analogs I kind of like for Ford, we were just talking about Macy's shuttering stores because its lineup of products aren't really popular anymore. Ford's kind of similar in that, do they need to continue to shut down and narrow their offerings, or have they done that enough? Are they concentrated enough in the high margin trucks to make the balance sheet more viable, to make it appealing as value, or do they need to still make efforts in their actual product lineup?
So you're right, they're in the middle of this vehicle portfolio reshuffling. And we think a lot of that has been done. If you look at, the bread and butter for Ford are their trucks, specifically the F-Series. In the U.S., Ford's truck sales were up 9% last year. Their passenger cars were down, other vehicle sales were down, but it's a multi-year restructuring that they're going through and kind of realigning the portfolio to products that are more exciting and that are going to sell with consumers. And they're kind of in the middle of that. They're in the early stages, but we do think the worst is behind them, and they're going to have better results both this year and more so in 2021.
Now, the leadership, the overall dynamic, the workforce, are there going to have to be changes to that too? Because when I think about what moves the shares, look, Macy's today bounced on news of closing the stores, but I think the market has a worry about Ford existentially, where incrementally new surprising information on that front could be negative. I mean, Tesla's going bonkers right now because apparently the market is saying this is the only cars people are going to buy in the future. I don't know. It's hard to keep track of the narrative at this point.
Sure, and we think the thing that is not really being accounted for properly with Tesla is all the competition. We're expecting 20 new electric vehicles to debut in the U.S. this year, some of which the comps are very similar to Tesla, the Ford Mach-E, for example, but also the Audi e-tron, the Jaguar I-Pace, and the Porsche Taycan. There were commercials featuring a couple of those the other night. But that's just an example of the competition that's imminent at this point, and competition which Tesla hasn't really had in recent years that's now here.
Yeah. Is Ford going to be able to be a part of that? Do we need to just go down the list of car makers and say, because I know GM, which we're going to talk about in a sec, definitely has the runway for that and is trying to make waves. Is Ford going to take part in that, or is just Ford going to take the other side of the bet and say, hey, people are still going to buy gas-guzzling trucks?
Well, we do think, kind of a multi-pronged approach does make sense. I mean, the fact is electric vehicles still account for less than 2% of total vehicle sales in the U.S. So, that percentage is going to grow significantly in the coming years. But what we like to talk about here at CFRA when talking about electric vehicles is the price versus range competition. So, those are the two factors that buyers really care about, is the price point, number one, but just behind that is the range. And, the Mach-E is a vehicle that's going to have a 300-mile range, 0 to 60 time, right around 3 seconds. So this is a very powerful vehicle. And we attended the Washington, D.C. Auto Show last week, and I can tell you that vehicle was the highlight of the show. There were, the biggest crowds were right around the Ford Mustang Mach-E. So we think, demand's not going to be an issue for that vehicle. It's just how many can they produce.
How about GM? General Motors is doing all right today. Earnings seem to be positively lukewarm in that they basically hit the estimate. There's no big surprises. Maybe the skeleton's out of the closet for GM a little bit further than they are for Ford?
So with GM, you're right. Their earnings were slightly ahead of expectations, but expectations were very low because the fourth quarter was impacted by the 40-day strike. But the key, really, what everyone was looking for was the 2020 EPS guidance, and they came out with 575 to 565. The consensus was 628. So the midpoint of their range, $6, was a little bit below consensus, but the stock is still reacting fairly well. It's trading up early here, following the open, but. Our main concern with GM is just their product pipeline just doesn't have the level of excitement as some of the other automakers. If you look, the Chevy brand accounted for over 2/3 of their U.S. vehicle sales last year, and sales of almost every model was down. Chevy overall, their sales were down close to 4% last year. So, they're just lacking, that kind of excitement that some of the other automakers have. So, we just put a note out and we've maintained our hold rating on the stock.
All right, interesting. Garrett, really good stuff here. A nice assessment as we're getting ready to trade a couple of these. Garrett Nelson from CFRA. Tom, let's start with Ford, all right? So hopeful on Ford here from Garrett's perspective, a little bit more neutral on GM, but let's start with F. How would you approach this right now? After today's dip, it's down almost 9%. So if you're feeling good about it, pretty nice time to buy, I would think.
Yeah, I mean, it's an inexpensive stock. I'm trading about $8.30. Yeah. So if you want to buy 100 shares, it's $830, right?
Beautiful.
So
I can do that math.
Outlay isn't that bad. And I think the key is what Garrett mentioned, over a 7% dividend yield now with it. And they said their dividend's okay here, 15 cents a quarter on that. So
you're buying the stock and you're selling a call against it.
Yeah, so cover return on this simple basic cover call strategy is where you buy the 100 shares of stock. For every 100 shares of stock you buy, you sell the Feb 8.5 strike call. You're paying roughly about an $8.15 debit. So that's about 15 cents below where the current share price is trading.
Okay.
But I think the key on this type of trade, it's longer term. You want to own the shares. You want to collect that 15-cent dividend every quarter. And you get a little bit of bump by selling a call against your long stock. So every 100 shares of stock, you sell one call. That's a covered return over 40% on an annualized basis, Oliver. And that's the key here. You're not outlaying a lot of cash because it's a low price stock at $8.30. But by selling calls against it, collecting dividends, your annualized return on a covered return basis is nearly 40%. So that is the key with this type of long-term strategy for investors that just want to hold Ford stock.
All right.
And collect those
Generate
dividends.
some premium. Okay.
Right. And
in
with
the meantime,
potential for it to go up.
All right. What about GM?
So I looked at another option strategy in GM. They've got earnings that are past. Garrett's basis is neutral basis on GM. $36 price target. It's trading just under 35 now.
It chops around a lot too.
Yeah, so I created a double diagonal trade. So it's a little bit more complicated. It's 4 legs.
Okay.
So I'm going out to the March series and I'm buying a strangle. That's where I'm buying an out of the money put to the downside, the 31 put, and I'm buying a 39 call above the market. $4 on each side of the current share price, which is just below 35. And then against that, to create this neutral strategy, I'm selling the 35 straddle in the February monthly cycle that expires in about 16 days. So you're selling the Feb 35 straddle, buying the wings in the March series, which is of farther duration. You're collecting roughly about $1.40 credit on that, Oliver. It's a neutral strategy. Takes advantage of the fact that you can roll that 35 straddle week to week or just month to month from Feb to March. But you've got a nice wide range here of about 32.30 to the downside and 36.60 to the upside. So it takes advantage of time decay, or theta, where the value of this contracts on a daily basis, so you can buy it back cheaper, or on those rolls, you actually increase potential profitability on a trade like this. But you do need it to remain over the next 44 days between those break evens of just above 32 and just below 37. So it's a neutral strategy. You don't expect much movement in GM shares for the next month and a half.